Welcome to Women and Wealth, the podcast from Investors Chronicle, aiming to give you the tools to make your money work harder, even if society makes your financial life harder than a man's. I'm Madelaine Apthorpe, digital production journalist at the IC.
And I'm Val Cipriani, personal finance editor at the IC. The idea with this podcast is tackling the big money issues that disproportionately impact women.
I'll ask the questions, and then Val, using her expertise, will offer some practical tips and some advice.
So it's a bit of a tricky topic, isn't it? Because the fundamental problem here is not something you and I can easily solve. It's more of a societal problem, and this podcast is not about putting the burden on women for things like the gender pay gap. What we're trying to do here instead is, just because for now society hasn't quite caught up, it doesn't mean that we should be miserable and poor throughout. So what we're trying to do is thinking about ways in which women can manage their money better, which will make a difference at the end of the day.
Definitely. Sounds really good. So, to be honest, I wouldn't say I have a huge understanding of finance. I know a little bit here and there, but I sometimes feel I should know a bit more than I do.
I think that's really very common, though.
Okay, well, that is really reassuring to hear. So what would you say to a woman who wants to build her wealth but doesn't really know where to begin?
Yeah, so I think the one place to begin is investing.
Investing, that's it?
Yeah, well, not quite.
Okay.
There is, if I say one word, and there is quite a lot happening in that word, isn't there? Because in simple terms, investing in the long term makes you richer, gives you more money. Not investing, keeping your money in cash makes you poorer.
Okay.
It's a bit straightforward, but
it does sound simple enough put like that. So, make your money work hard today and maybe in the future I won't have to. Sounds quite nice.
Yeah, that's the idea.
So we know women invest less than men, and that is the gender investment gap. I think you have a little bit of data on this, don't you?
I do. It's not very cheerful data, but I do have some numbers. So this is Borrowing Money research, and they've tried to put a figure on it. So the gender investment gap in the UK alone is valued at 678 billion. Now, that is a huge number to the point that it doesn't really mean much. And basically, it's kind of the size of the GDP of Switzerland, like a whole nation.
Okay,
it's a lot.
That is a lot. Do we know why it's so big?
Yeah, well, we kind of have some ideas. So part of it's about just women having less money than men. And that part is a bit hard to tackle. So, for example, as of 2022, men had on average about 93,000 more in wealth than women. So that's a 35% wealth gap. Again, quite a lot of money. And it kind of goes back to the gender pay gap. So last April, the gender pay gap among full-time employees was about 7%. So that is just full-time employees. So it doesn't take into account, women working part-time or anything like that, which women do because they tend to maybe stay home more to take care of children and all that sort of thing. So, yeah, just, you have less money to invest, your wealth grows less, and that's a big part of the gender pay gap and not a part that obviously we can fix, unfortunately.
No, it doesn't sound like it's particularly in much of our control, to be honest. So there are obviously, not all women are not working, so there must be some women who do have money to invest but are not, it seems.
Yeah, that's right. So again, this is just kind of like trying to work out the general trends. It doesn't mean that there aren't women who actually are very confident investors. There are many of them. But in general, the data from studies across the world seems to hint that there is a bit of confidence problem towards investing. So for example, in 2021-2022, actually more women than men added money to an individual savings account, an ISA. So that's, where you put your savings or investments if you want them to be tax-free, in simple terms. That's a UK thing. Okay. And actually, women do maybe have more to save in certain occasions. However, then if we look at stocks and shares ISAs, so those are the ones that are actually used just for investing, not really for cash very much, then you have 500,000 more men than women paying into one in the same year. Wow. So this tells you that women's ISA contributions were very skewed towards cash compared to investing. And similarly, 3 in 5 people who have a stocks and shares ISA on Hargreaves Lansdowne, which is the biggest platform that provides investment services in the UK, they were men. So, it is partly having less money, but it is also clearly partly just not investing.
Yeah, definitely. It sounds like seems to be a bit of a man's world, but it really doesn't have to be at all. So you mentioned a confidence issue with women. It feels like if we could just, wave a magic wand and give them all this knowledge that men seem to have that women don't have and all this confidence, then would they thrive as investors?
I would think they do. Well, first of all, because, we're not inherently different from men particularly, are we? So there's no reason why we shouldn't. But also there is some interesting data that suggests that actually women might be better at investing than men are in certain situations. Okay. Which is quite
nice to hear.
Quite unexpected. So I might go through one of these studies because it's quite interesting. So this was made by a firm that is called the Oxford Risk that specializes in behavioral finance together with Investec. And what they did is that they statistically analyzed the financial personalities of 2,000 people in the UK, Hong Kong, Taiwan, and Singapore. So it's quite a broad study as well. And they sort of looked at various criteria of the way these people were managing their finances, right? And what they found was that women, yes, they tend to be less confident investors than men, but they're also better at keeping calm in the face of market volatility, for example. So they are more likely to be in those personality traits, to have those personality traits that are associated with being good at investing. And there are some other studies that back this up that say that, for example, women are less likely to trade too often, and they are more likely to stay invested for longer in the same funds. So we'll discuss this a bit more in a second, but these are all qualities that are associated with, being a long-term investor, an investor that is able not to panic when markets crash. So in the long term, they are meant to give you better returns just because, you don't do those big mistakes that maybe men are more prone to do.
Yeah, I guess it seems like we're just less knee-jerk reaction when it comes to things like this. Okay, that's really, really looking quite positive for us then. Next, we will talk about why investing is so much better than sitting on cash, and a little bit about how we can reframe the idea of investing being quite scary. So Val, we've touched on why women invest less than men and why it could be really, really important to boost their confidence. So now can we focus a little bit on why investing is so much better than sitting on cash? And please try and keep it simple for me, so just a couple of sentences.
Yeah, so just some simple figures for this. If you put £10,000 in the stock market about a decade ago, you would have about £26,000 today. So that's, pretty good value. However, if you did the same thing with cash, so you put £10,000 in cash 10 years ago, today you would have about £6,400 instead. So this is Vanguard data as of early March 2025.
Okay, so cash makes you lose money, investing makes you gain money.
That is correct.
Okay. I feel like there's a bit of a but coming. Maybe it's not as simple as just two sentences, right?
No, yeah. Unfortunately, it isn't. But it does give you, I think, a really good idea of how this works. But yeah, there are some things I need to add, some caveats. So the first thing is that if you pay attention to the numbers, some people may be wondering why, how possibly cash returns can be negative. How does this work? And the answer to that is inflation. So inflation can be really, really nasty because it erodes the value of your money. So what this means is that, if you go out and buy something today, it costs you, say, £10. Next year, it's probably going to cost you a bit more, maybe £11. And this happens, every year for basically anything that we can possibly buy. So what actually happens is not that the money, shrinks per se, but what diminishes is the value of the money. So what you can buy with it, because at the end of the day, that's the value money has for you, isn't it? Is what you can use it for. So the numbers I gave are in real terms after inflation. So, if you had £10,000 a decade ago and you kept it in cash, today you only have 6,400 because with the same 10,000 plus whatever cash returns you make, actually you buy a lot less stuff. So that is the sort of the value of investing, is trying to keep up and beat inflation so that your money doesn't lose its real value. So that's really, really important.
Okay. And anything else that we kind of need to know?
The other two things are on the negative side, shall we say, or not really on the negative side, but just caveats that we need to add to those figures. So obviously with investing, the returns are not guaranteed. So, this is what happened to the stock market in the past 10 years. It doesn't automatically mean that you will make the same money or that you will not lose money. The risk is there, the risk exists. And you need to be very aware of it if you do decide to invest. So this is very important. And we will discuss later on some ways where, you can invest in the right way to make sure that you protect your money, but even still the risk is there. Okay. And then the second point I would make is that in the past 10 years, the stock market has done really, really well, and cash has done really, really poorly. So in a sense, those figures are maybe even the best they can be to make the case for investing.
Almost like the extremes of either end.
Yeah, obviously I don't have a crystal ball. Maybe we'll do it again in another 10 years. But the way things are now, it's looking like in the next 10 years, maybe cash will do a little better and stocks will do a little less well. However, in the long term, definitely investing tends to beat the performance on cash. And this is really, really important.
Okay, so investing tends to beat cash in the long run, but there are a lot of risks. So you really got to do your research. That's kind of what I'm getting. Well, to be honest, you've lifted quite a lot of the mist around it. So thank you so much. I think the industry or investing itself can feel like quite a gate-kept world that a lot of women maybe feel like they can't get into, but it's not the case at all. Like anyone can get into it.
Yeah, I think that's a very important point to make. It's like there's a lot of movies, there's a lot of ideas around it that are not necessarily actually the way things are, or they are in certain circles, but there's a whole different way of investing that is not, it's not the Wolf of Wall Street or anything. No, it's very it's actually quite straightforward once you start to understand it, basically.
Hi, you've reached the IC's Women and Wealth podcast. How may we help you?
I'm 27 and I have £20,000 saved. I want to start investing so it grows, but I hear all about risk and strategy. And to be honest, I don't really know where to start. Can you help?
So we've started to dismantle the idea that investing is this madly complex area that not a lot of people can get into. And we have a question from a listener who wants to invest but needs a little bit of help.
I can try. Okay. There's a lot to say around that, but I can try. I think the first point I would make is that it can feel like investing is this mysterious thing that is a bit like betting your money, that you don't know what's going to happen to that money. But that is really not quite the case. So what you're doing if you decide to invest is putting your money to work. And as a starting point, that is a really important way of reframing things, because otherwise you feel like you're throwing the money to the wind, which is not what you're doing. And then a second important point, she mentions risks. So risk is something to very much take into account, of course, but I think it can be helpful to reframe a little the way we think about risk. So, we said, she has £20,000. If she leaves the £20,000 in cash, it will lose value. So some of that money will be lost. So that is a different kind of risk that also needs to be taken into account, because that's also a way of losing money.
Yeah, of course. I didn't think about it like that, but that makes sense because cash goes down, investing hopefully goes up. But saying that, there are cases where the stock market does lose quite a lot of money, and I think that's maybe what she's saying about, the risk and maybe not knowing where to start. How can you ensure that doesn't happen to your pot?
Yeah, absolutely. And again, a very fair point. I think, I wish we had a whole podcast to discuss this, because obviously there's quite a lot of material to cover. But I think a few basic principles that are very important and are actually quite straightforward. So if you understand those and you get those basics right, then it is not as complicated as it sounds. So I might start by kind of listing the 3 key things that one needs to learn about, and then we can take it from there.
Okay, sounds good.
The first thing I would say is the concept of time horizon. So this is about how much time you have for your investments to grow, or in other words, how long you can afford not to touch the money you are investing. It's really, really crucial, because so if you want to invest in the stock market, you start by having 5 years, maybe 5 to 10 of money that you don't expect to need to withdraw in order to be able to invest fully in the stock market. And this is the reason why the stock market goes up and down a lot. It's very volatile. And sometimes it goes down for relatively sustained periods of time. So what happens is, if you need to take the money out when the stock market is down, then you are crystallizing a loss. That's what it's called. Okay. And then yes, you have lost money because you cannot afford to wait for the stock market to recover. So time horizon is really, really crucial. So the journey is just quite bumpy, basically. Just imagine a scenario where maybe our listener is looking to invest to buy a home. Okay, let's say she wants to buy a home in like 3 years or something,
so that's quite a short-term time horizon. Okay.
Exactly, the problem there. So, for 3 years, she invests the money and the stock market does really well. So after 3 years, she's got the money she needs to buy the home of her dreams, so she has a deposit. Excellent. Now it's time to take the money out. However, she gets really unlucky. And maybe what happens is that the stock market crashes a month before she needs to take the money out and buy the place. And now she has a problem because, she wants to buy the place now, but her portfolio has lost quite a lot of money, and she may even have quite a bit less than what she put in.
Oh, God, okay. And that's crystallizing her losses.
Correct.
Okay.
At that point, either she waits longer, so longer time horizon, or she's going to have to just take the loss. And then investing was not a very good shout to begin with, was it?
Well, so if you have a short time horizon and you know that, what is like a solid approach to your a solid take, I guess, to have you with your portfolio?
So there are ways of doing what is called de-risking a portfolio, so reducing the risk a bit. So obviously the most risk less the thing that has less risk is cash, as you can imagine. So if you have a very short time horizon, then investing is not for you, and you just keep your money in cash. But if the time horizon gets a bit longer, but you don't want to go fully into stocks, you have another option, which is what is generally referred to as bonds or fixed income.
Okay, and what's the difference between bonds and stocks?
Yeah, very good question. Very crucial difference. So if you are investing in the stock market, what you are effectively doing is buying a tiny piece of a listed company. So, say Apple or Microsoft, they're listing on the US stock market, and you're purchasing a small bit of it. So the performance of your investment depends on how those companies perform. So, how much more profit they're making, how the market feels about them, a host of things.
Okay.
So again, for these reasons, it's quite volatile. The bond market is a little different because a bond is a financial instrument that governments and companies use to borrow money from investors. So you're not buying a piece of the company, you're kind of just lending the company some money. So what happens is that at the end of the length of the period, the company or government pays the money back. And in the meantime, you receive an interest rate. Now, bonds are also on a market, so they have a price, they get bought and sold. But the basic principle is that this is way less volatile than the stock market, because it is not exposed to the same, to all the same variables.
Okay.
Basically, as long as, the company or the government does not go bankrupt, the financial instrument is kind of fine, put it in very simple terms.
And that's why it's good to have in a short-term time horizon, because you're guaranteed to at least get a little bit of income coming back to you if the stock market does fluctuate massively.
Yes, that's kind of the idea,
Okay,
yes.
you broke that down really nicely, so thank you. Thank you so much for that. Is there anything else that you or our listener would need to consider if she wants to kind of move forward into this world of building her wealth?
Yes, so I was talking about, some key principles. Time horizon, with it goes the usual, keep calm and carry on idea, which goes back to what I was saying before. So you don't want to sell when the stock market is down, and the stock market at some point will go down.
Naturally.
So, if you have the time horizon, you also need to have the calm to be able to say, I don't need this money now. The stock market is going down now, but it will recover. So I'm not going to touch my investments when they're down, which is actually kind of a difficult thing to do if you're maybe perhaps a bit anxious or worried. You have a feeling, this is going down. It's just going to keep going down from now on. I want to take the money out now. It's quite easy to go like that.
Especially if it's, a really important savings or maybe all your life savings. So important to stay calm, stay rational. I'll remember this. And there's a lot of mention, I hear about like diversification in a portfolio as well, but could you kind of break that down? I don't entirely know what that means.
Yeah, that is also a very basic and important principle. And it's about not putting all your eggs in one basket.
Okay.
So, if you decide to invest, you want to have a little emergency fund in cash, first place to start either way. And then for the money that you do invest, you want to have different things. So, you're not going to wake up tomorrow and be like, I want to invest and I'm going to put all my money into Apple. And, Apple is a great business. This is not about that. It's about the fact that you don't want to bet all your money on one thing. So the concept of diversification is about, exposing your money to different factors and variables. So if one thing goes wrong, maybe the other thing goes right, and then you're hedging your bets a bit in a sense.
A bit more equally spread.
That's right. Okay. Yes. So if you want to start investing, you look into things like investment funds that own, multiple companies. You look into passive investing, which is another way of investing into a number of companies at the same time. You do not look into picking stocks as a first thing.
No individual stocks.
No, it's very complicated. Okay. It's very interesting. And then if you see you like it, then why not? It's a great thing to do, but it's not maybe the place you start because there's a lot to learn and it's quite it can be quite overwhelming, I think.
I think that, that's definitely the thing. There is so much content out there, isn't there, that it can often feel quite overwhelming. So I do completely understand where our listener is coming from. Would you say it's possible to begin investing without knowing all of that and just, knowing the basics?
I think so. I don't think you need a huge amount of knowledge. You need some knowledge, especially about those basic things I was talking about. What I would do is look for a place that has some good guides to get you started and sort of don't try to get too focused on the small details and all of that. So, well, obviously, the Investors Chronicle is a good place to start. We've got some of those. Otherwise, if you start investing, you will need an investment platform. So this is where you go, it's a bit like a bank, but for investing. Like you open an account online, you put your money in, and then you go like, I want to put £1,000 here, £1,000 there. So there are many of them. The biggest ones are Hargreaves Lansdown, AJ Bell, Interactive Investor. On the Investors Chronicle website, we have some guides on how to pick your platform, which are the cheapest ones and all of that. But either way, whichever you pick, they tend to have very good guides for beginner investors. So that's also quite useful because they're quite good at giving you the first ideas on how to get started.
Taking your little baby steps into everything. Okay, perfect. Just lastly, any other practical advice maybe for someone like this?
I think the final thing I would say is just regular investing. So regular investing is quite good in multiple ways. First of all, it means that, you start with small figures. She says she has 20,000 to invest, but if she's not feeling confident, she doesn't need to invest all the 20,000 pounds in one go.
That's very true.
She can just, be like, oh, I'm going to go and put in 200 a month, 300 a month. So that is quite a reassuring way of doing it, I think, because it's more gradual. But it also have a technical advantage, if you want to put it that way. So because the stock market goes up and down a lot, you may be tempted to time it, be like, oh, it's down, I'm going to put a little more money now that it's down, which is in principle a good idea, but in practice very, very difficult to do. So another quite basic idea of investing long term is that you really shouldn't try to time the market because you can't predict if it does God knows what. So regular investing stops you from doing that, because you just go like, you can even, usually you set up a direct debit. It's usually possible with the platforms. So you just go like, I'm going to invest £300 on the first day of every month, regardless of what the stock market is doing.
And just hope for the best.
Yes. And that also, it smooths out the volatility a bit, because if you put £20,000 in one go, well, what the stock market is doing that day will matter quite a bit.
That's very, very true. This podcast is all about supporting women on their journey to make their money work harder for them. And there was so much useful information in this. So thank you, Val.
You're welcome. I hope this episode has offered you and our listeners some tips and practical information to make you feel more confident with your money.
Definitely. And if you enjoyed this episode of Women and Wealth, make sure to subscribe to Investors Chronicle on whatever platform you get your podcasts on. And also head to investorschronicle.co.uk, where you can start a 12-week trial for just £12 and get access to all of our stocks and shares news and analysis. Also, if you have any questions for me and Val to unpick in the next episode, drop us an email at womenandwealth@ft.com. Thank you for listening.